just yesterday, Carta released their Q4 numbers for all of venture for 2024, and actually for all of 24, kind of like the annual report. So we sit down with Peter Walker, the head of insights, who leads the entire effort and practice at Carta of understanding the data better than really anybody in the world when it comes to venture, because they have ground level data about cap tables across all of the US and globally of what's exactly happening. And so this is private market, so it's always hard to get true data. But Carta's data, frankly, is the closest you can get to truth and not just what gets reported by headlines and TechCrunch and all these sort of things. And we have the first live conversation about what happened through 2024, what happened in that final quarter, where are the trends going, where are valuations at, where are round sizes at, what's happening with team sizes. We talk about how teams are actually getting smaller even though fundraising levels are up. What are people doing with that money? This is trends that you as a founder have to understand, because believe me, VCs are looking at this stuff. And so if you want to be on balance with them, this is stuff you need to know.
That's product market fit.
Product market fit.
Product market fit.
I called it the product market fit question.
Product market fit.
Product market fit.
Product market fit.
Product market fit.
I mean, the name of the show is Product Market Fit.
Think back to the last few months, the last few years as you've been running the startup. How many different founders have helped you out? The reality is founders help each other out. That's just who founders are. They pay it forward. So help a founder out. Take literally 5 seconds, take your phone out of your pocket and hit 5 stars. Peter, welcome back on the show, man.
Thank you so much for having me back. Appreciate it.
Dude, well, looking forward to getting your takes on what's going on in Q4. I mean, frankly, like as a VC and just someone in the startup world, like the only thing I hear about is AI, and more AI and like bigger rounds and even bigger rounds. And then like, a bunch of DeepSeek stuff, but like mainly just AI and big AI rounds. So I'm curious what you're seeing in the data. Hopefully there's other things than just that.
No, that's it, man. That's all we got for you.
Done. All right. Episode done, man.
Yeah, I mean, this was easy. No, look, there are other things going on, although I'm not surprised that AI is dominating the landscape. I think as we looked over our data through all of 2024, so just talking about the full year that was here, we saw about 20%, 18 to 20% more cash raised by companies on Carta in 24 than 23. So that's obviously a boost. But the actual number of rounds was down about 5%. So this sort of dynamic of bigger rounds going to fewer companies, I think it actually is true, especially at the earliest stages. Early stage, activity, the fundraising pace was effectively flat from 23, and 23 was not a great year by any means. So I do think that feeling across venture, which is there's some companies, typically AI ones, who are just speed running this thing, and then everybody else is caught in this sluggishness. I think the data sort of does reflect that there's still either kludge in the system or people are trying to figure out what venture looks like in a world of AI and lower round counts. I was expecting candidly that 24 would see a pop back in terms of fundraising pace much more than it did. I was pretty surprised by that number.
And I know you're not necessarily a fan of splitting the data this way, but like what percentage, in Q4 or maybe, throughout the year is going to AI companies?
Yeah, when we look at the total split by round size, or excuse me, by round stage. So you've got AI in seed and Series A, it's probably something like, 30 to 35% of all the capital that we see or saw last year is going to AI companies. But the weird part is, if you look late stage, it's actually much higher. So 50% almost of every dollar that we see invested into, say, Series D and Series E companies are going to AI companies. And that's a dynamic that's very odd. Like usually in a technological change, it would start at the beginning and then a higher proportion of capital would go to early stage rounds. And then those early stage rounds would graduate, et cetera. Again, AI has just kind of done this very quickly, where now even the late stage is dominated by, we all know the names. There's like 10 companies that seem to generate gigantic rounds, and that swamps everything else.
Yeah, I mean, part of it is that kind of distortion, like whether it's OpenAI, or I think another big one was Databricks, just raising a ton of money and just kind of skewing the numbers that way.
Even if you take it at round count instead of just dollars, it's still a higher proportion in late stage than early stage, which I think is odd.
That is weird.
There's a discussion, I'm sure you have it as much as I do, about can non-AI companies raise in this environment? The answer is yes, definitely. There are non-AI companies that are raising but I don't know whether or not, when does AI stop being this hype cycle and a justification for a round and simply just becomes the technology that individual companies are using? It, it's got to happen at some point in the nearish future where
100%. And for me, it's already happened. Like at least in the way that I look at, like maybe it's not in the data, but like I just don't like people will ask me, what do you invest in? And I'm like, I can't say I invest in AI. Like that's just so stupid. Like it's just like saying, oh, it's like in the 90s or early 2000s, like I invest in the internet. Like come on, who doesn't, right? Or like in SaaS, like in the 2010s, like of course you do. Like everything's just that way. If you're, so like these days. I mean, there are core AI, like I look at our companies and I'm like, okay, you're actually like foundational model or like, there's one we have that's like doing like a CUDA competitor, like, true like foundational pieces of the stack that are core AI. And then there's people like more AI agents, right, that are leveraging AI for a bunch of different things, people that are leveraging AI in their products. But again, like it all starts to be this like weird like spectrum where it's like, are you AI or are you not AI? And then to your point, it's kind of like, well, who cares? Like, you're probably leveraging AI as much as you can. The only other side to that though is I'm like, yeah, if you are starting fresh today, you know, it is the inflection point. Like that is the big change in the market. So there's a reason why many founders would do something that is AI, not just to be hot, be in AI, but just because of the opportunities, that it might have opened up.
totally. I think that this is the annoying part about the AI discussion is like if you're a young entrepreneur just thinking about beginning a company, like you should take advantage of the latest tools available to you. So in some ways, if you're not looking at AI at front, it's very odd. It's like, why are you just doing this like as a contrarian thing that you just don't think that this technology is that helpful? I mean, fair. I guess that's a viewpoint that people can have, but many other founders disagree with that. So I think it's just going to become less and less the story of AI versus everything else. And then the story in 25 and 26 is going to be AI integrated into everything. So we stop talking about it as a separate idea most of the time.
100%. What else? What other big kind of trends were happening in Q4?
Man, Q4 was a pretty good quarter in terms of valuations. We saw rising median valuations for seed stage, for Series A, for Series B and Series C. Things kind of leveled off a little bit, but again, the story that has been basically the story we've been telling through this data for the last, call it, I don't know, 6 to 7 quarters here is valuations continue to creep up on a median basis and round volume is either flat or a little bit down. So fewer companies, but they're achieving robust valuations when they raise. The other thing that I've started digging into, which I love your opinion on actually, bridge rounds is this big. If you look at our data, there are so many more companies that are now raising extensions after a primary round. So if you just look at seed, for instance, companies that raised something like, I don't know, 35 or 40% of companies that raised a seed round end up raising some sort of extension capital after their seed before they get to Series A. And when I looked at the difference between those kinds of rounds, so there's two ways to raise a bridge round in our data. One is to do it on a priced round, which takes time, takes lawyers, whatever. And the other is bridges that are using safes or convertible notes. Those bridges have become a lot more common, the safe and notes one, and they graduate to Series A at a wildly lower rate than the ones who don't bridge that way. And I have a feeling there's this kind of tricky feeling that I'm experiencing right now where I think there's a ton of time and attention and money being spent on bridges that are going to end up being completely wasted. And I didn't really feel that way until this end of this year. But now I'm looking at it since 2021. And I just think, I think that there's a ton of bridges to nowhere that have been raised over the last 3 years.
That's very interesting. I have a lot of thoughts on bridges, but maybe just first on the data, like so like right now, 35 to 40% of seed rounds have a bridge after. Is that right?
It's 35. It's called 30% of companies that raise a seed end up raising a seed extension of some kind before they get to an A.
And what's that trend like? Was it always 30 or was it like 15% before?
No. It's definitely gone up. It's gone up quite a lot. Like, so look, and obviously the time factor comes into play here. Like if you raised a seed extension in 24, I don't know whether you're not going to raise an A yet. You didn't raise a Series A in 2024, but that was kind of on purpose, right? You did a bridge. So we don't know what the ultimate value of those bridges are going to be. But if you take, I'm looking at data from say 2020, the percentage of companies that raised a seed round in 2020 and then have raised some sort of bridge capital since then on a safe or a note. Only 4% of companies that fall into that bucket have gotten to a Series A. 4% versus 50% of companies that didn't raise a bridge round at all. So obviously, if you're raising a bridge round, probably it's not the best thing because, hey, why did you need to bridge in the first place? So I get that. We should expect the numbers to be lower. But safes and notes as like this extension capital, the end result of those, I think, is almost always not good.
It's interesting because I have like a few different kind of perspectives on this, and purely from like my viewpoint. I mean, one is I wonder, we have that COVID period, that 21 and 22 part, which is so hard to kind of pull out, because in that time, it is true that if you were, let's say, 12 to 24 months post seed and you couldn't raise an A, in most of those cases, we're talking generalities here because there's so many exceptions to every rule, but like as a rule, something was wrong because it was, capital was flowing, it was going. So like that kind of makes sense to me. That foots, at least again, anecdotally, it's like if you had to raise a bridge round, like you said, nobody wants to raise a bridge round. Everybody would rather raise the primary round. It's a higher valuation, it's more money. So if you had to raise a bridge round for that 2020 cohort, it was, you were doing 21 or 22, like it probably meant something was not really working. And so then you're already kind of in this, you have this adverse effect, whatever that's called, but like you're already looking at the sample that's no good, right? Or not, lower quality, let's say. But then you fast forward and you look at the companies as an example that maybe raised the seed, in like late 21, or certainly let's say like even in 22, right? They raised the seed round, and then the rest of 22 was soft. 2023 was also kind of soft. And now, I think now, we talk about this later, it's starting to get hotter again. But in any case, those companies, the bar for a Series A had moved up, like even just maybe from where, when they raised the seed and they thought about where they needed to be to raise an A, and that yardstick just kind of kept moving as they approached it. And those companies, and this is now where I'm saying, like, based on my own, let's say, things that I've seen myself, either in my portfolio or outside of it, but like seen personally, and it many times raised seed extensions. And I'm not sure whether the quality of those companies was actually worse. I mean, obviously, if you compare them to the percent that just raised an A, in general, obviously it's not as bad. But like if you compare to the average seed company, right? Like you have the companies that raise the seed, they're whatever quality. Some raise an A right away, okay, they're top. Some don't raise anything, and then some raise the bridge round. Like, that's where I'm less sure, especially because what I found is just like the jump in valuation between a seed at, you can, these, but like 15 million or so, 20 million, right? Probably median valuations, to like your 40 or 50 million valuations at Series A. It's a big gap, and just sometimes, I have seen it again in these not so hot last, let's say, 8 quarters, where it's like, you know what, like you're actually on a good track, but you just need a little bit more juice to really be able to get there and raise that like big, great 10 million plus Series A, versus having to like, go to market and raise a price round, but maybe it's like 5 or 6 million and you're almost in this like no man's land.
I totally hear what you're saying. There's a part of me that wants that world to be true where a lot of these extension companies are like really consolidating and like going to be good candidates moving forward. The worry I have is that it may just be the case that many of those companies that ended up raising extensions are going to get swamped by younger companies that are moving faster. And they don't have some of the cap table dynamics that the maybe seed rounds from late 21, early 2022, et cetera, have. And so when we look at these graduation rates, for instance, hugely, everybody graduated in 2020, 2021, it was too high. And then 2022, it was very low. Like even after 2 years, only about 16, 17% of those companies had got from C to A. Usually that's 30%. So a lot of companies got like stuck. effectively at seed. And now they're doing what they can. They get bridges, creative financing, et cetera. And then the question is, will a lot of them end up getting to A at any point, or are they just gonna get like, boat raced by the companies that are coming up behind them? Because they are growing, as you mentioned, Series A metrics. What you need to raise a Series A has gotten conservatively 2 times higher, 3 times higher than it was 3 years ago. Um, and that's just because a lot of these companies are moving so much more quickly, AI, et cetera, on top of that. So I kind of, I'm a little worried that a lot of those glutted companies are just not going to really end up being anything.
I think it's a fair point, and it's totally a legitimate risk because again, like you had, I mean, basically, and I know there's GPT before Chat GPT, but like there's still the Chat GPT moment at end of 22, and in terms of the sort of things that people were building, it all changed through 23 and 24, and so like if you had like a 2020 or 21 company pre Chat GPT, you're probably like not really AI at the core. You're doing whatever, 22 comes along, market sucks, you raise a bridge round late 22, early 23 and the world's like changing kind of behind you. And then that new YC company or whatever that's born in mid 23 with all that knowledge just goes out and starts building like AI agents and doesn't have any of the baggage that you had. And in many instances can have like an equally or more compelling product. Yeah, it's not going to be as feature rich, but they might have like this one pain point thing that because the AI agent is just so well suited to do that. And really the ROI is so high that you're actually like trying to build that in while having everything else. And you've got the cap table baggage. It's not, I've seen it like, I'm seeing it on both sides and the companies that are like, they were the 2020 cohort and the new companies that are actually going to come against some much bigger companies, but that are kind of pre, let's say, ChatGPT moment. And it's an interesting dynamic, right? It's yet to play out, but I think it's an opportunity for the younger ones and a risk for the later ones. And I guess like that's the whole idea of like tech disruption.
100%. It's just funny that happened to these youngest companies. Like
Yeah, yeah,
usually
yeah.
they're like, oh, they're at seed stage, they're the disruptors, and they're like already getting disrupted by
Exactly.
behind
Well,
them.
the older ones at least have distribution, right? And distribution in this for this era is very helpful because AI in a way is actually kind of easy to add. And so if you have distribution and you add this AI element and everybody gets efficiency, like it's huge. But if you don't have distribution yet, but you do have some baggage, sometimes it's better to have just like a blank slate and just start from zero.
Yeah. I kind of feel for the entrepreneurs who are kind of caught in that transition moment because it's not easy by any means usually, but it's, I think, even harder when there are these macro winds of low fundraising environment, plus the advent of AI, plus all these younger companies that are coming up behind me. Like it's just a quagmire. So it's tough. I do think that there's, one of the ways that founders that from our data are responding to that is just this is one of the trends that's been very clear since the beginning of 23 is they're just not hiring. They're just hiring way fewer people per unit of revenue than they used to. And that's great in a way. You obviously, you've got ARR per employee that's going up. You've got, these capital efficient businesses. Part of me is a little sad. Like it's super awesome to work at an early stage startup, and I wish more people got the chance to do it. But I totally understand why companies are choosing that. It's just that's one of the clearest patterns in our data from 24 is companies are staying smaller a lot longer than they used to.
Do you have numbers on that? Like how many employees the average company, seed company has, and maybe even like ARR per employee, these sort of things?
Yeah, totally. I not on the ARR side, but I can give you like full-time equity holding headcount. So that's the first part. Caveat to this story is we can see very clearly equity holding full-time employees, but if their companies are doing a lot with consultants or fractional that don't get equity, it's a little bit harder to view that. But just on a aggregate basis, if you look at a company that raised a Series A round in the first half of 21, on Carta, they had a median employee count of about 20 full-time headcount. Now at the same company raising a Series A in 2024, that was more like 15. And the second half of 2024, that was more like 13. Which,
Wow.
yeah, the gap between 20 and 13 doesn't feel big, but those 7 headcount represent a gigantic decline in the number of employees. So a lot of people are really scrutinizing new hires that way. And I honestly don't know, usually if this had happened, you would say, okay, as fundraising picks back up, hiring will pick back up. But in the AI age, I don't actually know that to be true. And I'm not sure where startup employment goes long term that way.
I mean, there's so many things too, because you have the freshness of all the insanity that was 21, 22 in founders' minds, whether they lived it or their friend lived through it. They're like, the last thing I want to do is overhire and get like, get my burn just too high. Like, that's just so fresh in people's minds. And then on top of that, you have a way to fight that, which is, like you said, through AI. I must admit, like, as a founder, I think it's just awesome. Like, smaller teams that can still get the stuff done, like where you don't feel like everything's just falling by the wayside. You need more people, but where it's not resource constrained, right? It's by decision. It's very powerful because you do trade off as you grow your team. Like, you need more communication, more alignment, more overhead, like things you can do more, but you can move. It's slower to move. It's slower to like get things, make new decisions. So the ability of companies now maybe having the best of both worlds, like a lot of money in the bank, a lot of ability of getting a lot of things done by leveraging AI, and yet that small team where communication, overhead, etc., is like, it's very, very small overhead, very clear communication, very clear alignment, is a very powerful kind of dynamic.
All right. So as the VC in this conversation, what happens if those companies don't need the cash? Like, they were spending the cash, used to be spending the cash on headcount primarily. Now maybe that goes to compute or other places, but the idea that compute costs would equal headcount costs, I think is that would be a large assumption. Like, what happens to companies that are coming up and they're saying, look, really, I liked the venture idea. I took a round. I have some outside investors, but I don't really need more capital right now. What happens to like growth VCs?
That's a great question. I'm just happy I'm not a growth VC, man.
Really? Yeah, no.
It's funny. Like, for us at Seed, like, we're so aligned with the founder from a cap table perspective, because in the traditional venture model, like, we're going to be diluted 4 or 5 times to an exit and sit behind a prep stack, take on all that risk, just like a founder does. So, like, in a way, like a world where we talk about like that one employee $1 billion company is kind of this like idea in your head that, still far from reality, but just maybe a North Star sort of thing. The idea that a company could raise $1, $2, $5 million, let's say, and just go and still grow exceptionally fast and still hit, real scale, but just become profitable a lot sooner is like music to my ear. Like, to me, that's awesome. That's just best case scenario.
Is it best case scenario if then you don't get any markups for your fund?
If that's the case, then, there is that interim period that's a little bit challenging, but we have other ways, and frankly, like, we started looking internally at measuring our performance by like revenue generation, like how many companies on our path to 10. And so I think it is. I think like the net effect is everybody makes more money, the founders, the investors, the LPs. And in the meantime, I think like if you're a smart LP, you can see through the kind of net IRR as just like the metric and look at the underlying portfolio company. And if I have a company, hey, we invest in this company, we own 20%, and it was doing nothing, and now it's doing 50 million ARR. Yeah, it hasn't raised, but like, you don't have to be that smart to be like, okay, that's interesting.
If the LP doesn't understand that, maybe it's not the right LP. Yeah, I agree with you there. I do think that this dynamic though pushes, it's why, it's part of the reason, it's not the only reason, it's part of the reason why some of those multi-stage funds and like late stage venture is getting so wacky these days. It's like, we have billions and billions of dollars to be invested, but it seems like the candidates for that investment are lower than they used to. So we're just going to plow some crazy rounds into these companies, and we're going to do it again and again. And it really does suggest that there are like two different parts of venture opening up, and the gap between early and late stage has never been this wide. And I don't know what happens to
do you
venture.
see that? Like, does that show up in the data? Because intuitively it makes sense. It's like, hey, it used to be, marketplaces and customer acquisition and product and engineering. And now it's a lot, product engineering still there, but the marketplace stuff, like the really expensive Uber-like models, they're not really happening. That money is maybe going to like GPUs, but like, who's really doing that? I mean, foundational models, like the really big at scale companies, everybody else doesn't need, that scale of, of spend.
Okay, look at the venture dollars raised in 24, which we all know is like billions and billions of dollars, but very concentrated to name brand funds primarily. what return can those funds get on those billions and billions of dollars? You mentioned it. There are like 8, maybe 5 foundation model companies that can gobble up cash that way. Although, we can talk about what DeepSeek does to that. Where does that money go? How is it spent effectively? I honestly don't know. It's a venture, I think, is going through this moment of, it is not this tiny kind of scrappy asset class anymore. It is professionalized. We probably need to start talking about it the way we do with private equity, where there's like low, middle, high. There's different kinds of private equity that have different strategies. Like venture is not a monolithic thing. It has different strategies, and different investors are going to need to differentiate themselves by the way they talk about themselves moving forward. Because it's a totally different game to be deploying a $2 billion fund than a $100 million one. It always has been, but
100%.
it's even more different now.
And, the other thing I wanted to touch on is there's this feeling, and it might just even be like me, but it definitely feels like the winds are shifting and we're going from, and I think it's weird, right? Like the stock market has been on a tear for like a decent amount of time, like basically since 2023. But in the world of like seed stage venture, it's been for a while that the thing just gets repeated. Like, oh yeah, it's just not, it's not the best time to raise a fund. It's not the best time to raise a round, like as a founder or whatever. To me, it feels like that story's kind of over. The winds are changing, and it's actually a great time to be in business. But is there anything in the data, like the last few months, that are showing like basically it feels like things are getting hot again? Is there anything that sees that in the early stage, or is that just straight up in my head?
Let's see. What could be pointing towards heat in the early stage? I mean, look, the number of rounds and dollars deployed in, say, seed and Series A was basically flat to a little bit up from 2023, but the Q4 was a pretty good quarter versus Q1 or Q2. So there's a bit of a ramp towards the end of the year. That's definitely
And
true.
the round sizes or round prices in Q4 versus the rest of the year?
Round sizes and round prices were let's go with seed stage, for instance. Seed stage round primary median valuations for a seed stage round on Carta were 15 million in Q4 after being 14.5 in Q3 and 14 in Q2. So rising up, that's pre-money. So then you add in whatever 3 million raised or so, and you get to pretty high valuations for seed stage companies. Series A, kind of the same thing, actually a little bit flat in Q4. So yeah, prices and cash continue to rise pretty slowly, but they continue to rise. I also think that there is this dynamic of location that is really geography comes into play here. Like the whatever happened in 20 into 21 into 20 or beginning of 23, where it kind of felt like Silicon Valley had lost a little momentum, like that is definitely gone. Like we see
Didn't last
SF.
long.
Yeah, SF is ripping. Even in comparison to what it usually does, I think it's ripping. And I don't know, especially that's an AI story to a large degree. There's so much AI in the Bay and in New York. There's less AI everywhere else, and I am waiting for that to change. And we haven't seen it change significantly yet, but I would imagine 25 is the year where AI becomes the dominant theme in the non-major ecosystems as well.
Yeah, I would have to think so. Any final trends? Like maybe what's the top 3? I mean, we talked about conversions, we talked about kind of prices, overall the year, like things are, seemingly getting better. There's definitely this dichotomy of like the really, really high, big, huge rounds, and then things at the early stage, kind of more, let's say, normal, and then the opportunities that people have to do kind of more with less. Anything else?
I think the other thing that we didn't touch on yet is exits. So Q4 24 saw the most acquired companies off Carta than of any Q4 in our database, even higher than 21. So now, a caveat, we don't actually know for what price those companies were acquired in most cases. So we don't know whether or not those are acqui-hires and fire sales versus, acquisitions that really make people a lot of money. But we do see a trend towards increased M&A. I think that's definitely going to be true in 25. Probably some bigger deals than were under consideration in the last couple years for sure. And then we're all just sitting around waiting for those IPOs. Like when Service Titan going out, there's a couple other ones on the schedule. It's just, Again, I think it's always underrated the impact both in terms of morale and actual recycled capital that IPOs
What's funny
have
is
on
if you look at like, the names I think about that are, I guess they're not that recent anymore, but like Duolingo, Reddit are two names that come up, in my head at least. And they're crushing it. Like they're up like
Reddit's
5x since IPO. It's insane. So I'm like,
I thought that was going to be more of like a starter gun, right? But it didn't really materialize into a big bump in IPOs. But I mean, that is the conversation when I speak to a lot of later stage VCs these days is like, when is liquidity really going to start opening back up?
makes sense. Cool, man. Well, dude, appreciate you sharing all of that with us. It's always great to have you on the show, man.
Absolutely. Pablo, great to see you, man.
Listen, when you go to like a restaurant, you eat a nice, meal, maybe a fancy one, maybe not. Do you leave a tip? I assume you probably leave a tip. You probably leave a tip 100% of the time. Well, guess what? A review is just like a tip. And I know you haven't been leaving one. So just like the waiter that doesn't get a tip after hours of great service, I'm getting a little frustrated. So take your phone out and leave a review. It helps the show move up rankings. It helps us get better guests. It doesn't just help me. It helps way more founders. Thank you.